how wealthy families save real money planning for college. What if we told you that the government is willing to help defray some of your children's college costs, or grandchildren's college costs for that matter? But remember, there's two sections. There's the college planning for the informed taxpayer, and there's the college planning and education planning for the uninformed taxpayer. So we're going to talk about real strategies and the strategies the wealthy use to try to help defray some of the costs and have the government help subsidize some of the education. As certified financial planners, we've helped lots and lots of clients think about how to save 5 and 10 and 15 and 20% on educational planning and have the government help subsidize that. So if you're hopeful for scholarships, we're going to give you some strategies that will make that less relevant, less important for you. These strategies, whether you have toddlers or whether you have teenagers.
What I found is the kids that get the most discounts and pay the least for college are the best students. Colleges will discount tuition for the better students. So it's a way of incentivizing kids and grandkids to study harder, if you will.
Scholarship money is far more prevalent, I think, and we're not talking about athletic scholarships. It's far more prevalent, I think, than most people give credit to. And if you can get scholarships from the universities or the colleges or wherever.
A real live example is our nephew who went to an out-of-state school but paid in-state tuition, which was a significant discount had he had to pay out-of-state tuition. And he was a good student. They wanted him. So I share that with clients all the time because it's a real incentive for kids to study harder in school.
Yeah. So most clients think that there's only a couple of options: save money in a bank account, save money in an investment account. We're going to talk to you about some strategies and things that we think make sense for you and the complexities of doing it. Some sound perhaps better than maybe they are. Why don't advisors mention this? I don't know. I think it's part of the more holistic planning. Maybe they feel like there's not enough money in it to be able to provide the advice. But if you're looking for holistic advice, I think it's part of the plan is in terms of what you should be doing.
Sand traps change. They don't keep up with them and they just don't pay attention to it.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions.
According to College Board, 4 years of tuition averages about $230,000. You think about it, that's really unaffordable for a lot of people without loans. For those of you who are fortunate enough to be able to help plan for children or grandchildren or even nieces and nephews, we're going to talk about some of the things you can think about. Now, if you're in the high tax brackets, how much money do you have to earn to net that $230,000? College is after tax.
$350,000 to $400,000, depending on what tax bracket you're in.
So let's look at some of the strategies. We'll look at the most prevalent one first. The 529 plan. 529 plans are plans that are run by states, but allow tax-free growth. Now, if you start at zero, think about this. You put $50,000 in a Roth IRA the day your child or grandchild is born. If you were able to earn 5%, when they turn 18, the account will be worth about $120,000. I mean, think about that. And if you use a 529 plan for college education, it's 100% income tax free.
Instead of buying kids toys and buying kids all kinds of gifts, if you each year make a donation or a contribution to the plan, it's good for grandparents too, because you need that 120 to get to 230 or higher. So you need to feed it after you start it.
Right. Now, one of the objections to them is what if the child or grandchild gets a scholarship? And what would happen is there are tax disincentives for doing it. You'd have to pay the income taxes on the gains. If you put 50 in, it was worth $120,000 in your
plus a 10% penalty.
But not if there's a scholarship. If you take the money out without a scholarship, there's no 10% penalty. So it isn't as onerous as you think it is, and we think it's still worth the risk of a scholarship or your child not going to college.
Well, the other thing is you can move it from one kid to another. And most people don't realize it. They think they have to have them all fun. You can move it from one to another. I had a situation where the oldest kid got a scholarship. So the dad moved all the money from the child one to the other three.
I think another aspect of these is we talk about college, but it's an accredited secondary institution. So it could be a trade school that you could use the money for. We think that's a huge benefit for people. There's a lot of flexibility in being able to use them for education.
I've had a client use it for primary education, not boarding school, but private school, up to $10,000 per year. He might as well put the money in the near term, earn tax-free returns, and then pay it out with after-tax dollars.
Yeah. There's another thing called a Coverdell plan. Sam, why don't you touch on the Coverdell plan a little bit?
Yeah. Now there's phase out limits, but you can put $2,000
Income phase out limits.
Yeah, you can put $2,000 a year from birth into the plan. It's really, really flexible, even to some degree more flexible than 529s. Money grows tax free, and you take it out tax free to pay for school. But you're maxed out at $2,000 a year, $36,000 through age 18.
So we don't see them as often. They're out there, and for the wealthier end of the spectrum, they may want to use them. But again, we have the income limit. So it's one of those, if you have enough money to put it in there over and above the 529 plan, might you exceed the income limit? There's also and this is relatively new,
Established in 2025.
The American Opportunity Tax Credit. Again, there are income limits, but it provides tax credits to defray some of the college expenses. This would be done more on your tax return and planning with your CPA or doing the tax planning. But it's something available that we have to be thinking about.
You can get as much as $2,500 a year or $10,000 over we talk about 4 years. Most of these kids go to school 5 years anyway. So it's, it could be $12,500 in that regard.
Another aspect is custodial accounts. So back in the old days when we were kids, people made custodial accounts. They were investment accounts, they were bank accounts, whatever it may be, where they put money away in the child's name. Now, legally, that money is the child's. And at the age of majority in our state, it's 18, that money becomes the child's property. So at age 18, if the kid comes in and says, hey, I want to buy a Corvette, that you see it out in the parking lot, there's nothing you can do. There's some maybe minor tax advantages. I don't find the kiddie tax was what we're talking about to be that much of an advantage, but it's something for you to be thinking about in terms of your long-term planning. Does it make sense? Maybe it does, maybe it doesn't. It all depends on your situation. The most important thing, you're armed with the right questions to ask. Does it make sense for me or does it not within my budget and my unique set of circumstances? I'll talk about a success story. And when my kids were 2 or 3 is when the 529 plans came into existence. Because we originally had custodial accounts for them. And I saved and saved and saved. And our parents, instead of birthday money or Christmas money, they put money in the kids' 529 plans. And by the time they got to college, we largely had enough money to pay for their college. And all of the growth was income tax free. We were able to take it out, pay for tuition, room, board, computers, and be able to defray all of the costs of college from that.
And that was really helpful because by the time they were in college, we ended up in higher tax brackets. So the tax-free return from the 529, the impact was magnified. And I think that's common. People will earn more money 18 years later than they did when they put the money.
I think the best advice, and it's always start early. Start when the kids are born. Create a 529, create a plan that makes the most sense for you. Sam said you could pass it from one child to another. You could pass it up to first cousins. Here's another important distinction. If you put that money away for the child and the child, when they're 0, you don't know if they're going to turn out to be a good apple or a bad apple. If they end up turning out to be a bad apple, that money isn't theirs in the 529 plan. It's the custodians. It's the parent or grandparents' money.
That first cousin thing's important to grandparents, who usually are the ones that are moving the money around in that regard.
So think about what to do. Calculate what is college education going to be. Education, secondary education in general, has gone up more than inflation. So start thinking about now, how do I want to plan for this? Can I afford to do it? Most importantly, start now. And then coordinate all these different plans and whether one makes more sense to you than another plan. And think about how do I get state tax advantages from this? But again, it's all about the right question to ask. One of the things,
just to be clear, you're not relegated to one strategy. You can stack them. So you can use multiple strategies to defray the cost even further.
And I think a really important aspect of this and things for people to think about are, there's not a grandparent that I've ever met that isn't interested in their grandchild's education. Education is very, very important. I think it will always be important. So that's why I think the government has this emphasis on incentivizing people to pay for the education. The tax code's going to help us. Again, if you're an informed tax code user, it's going to help you. And if you're an uninformed, you're probably not. Think about it. We talk about investing being the easy part because it is. It's all these other tax strategies, and the wealthy get wealthy because they utilize these tools to get advantage. And they're always scalping a nickel here and a dime there, and over a lifetime, it makes a tremendous advantage for you. Because investing is the easy part, navigating the tax code isn't. You've saved tens of thousands of dollars on college, but that's just the beginning. The next video reveals how wealthy families operate under a completely different tax code and do so legally. Watch now to see which tax code you're stuck in. Making over $150,000? Find out your real tax rate and book a call below.